Investors are awaiting tonight's election results, but the Fed could have a bigger impact on the markets this week. The Fed concluding its two-day meeting tomorrow, and economists surveyed by Bloomberg News expect the central bank to announce a plan to buy at least $500 million in long-term securities. And while analysts try to figure out how much the Fed will spend, our next guest also has some concerns about the Fed's process itself. Joining us right now is Neil Grossman. He's managing partner and chief investment officer for TKNG Capital Partners. Neil, great to have you here.
Thanks, Carol.
You're worried about the process. What is it that you're worried about?
Well, you got to ask yourself what the Fed's trying to accomplish. And I think at the heart of this, they're trying to get employment up.
Right.
But I have no clue, honestly, how when they buy treasuries, which is the process can go on, that they're going to actually do that.
And even they've said, right, that they won't be able to have a direct effect on employment. They're hoping to boost inflation and through that get some traction on employment.
Right. So the question is, how does inflation actually help the economy? And as you know, I think that quite the contrary. There are some real negatives about inflation. And I think the problem is there's two types of inflation. There's the inflation the Fed wants to affect, which is things, for example, like wages and probably housing prices. And there's a type of thing where you've seen the effect already. The minute the Fed started talking about more QE, the dollar started to depreciate, and you saw the effect of a weaker dollar result in much, much higher commodity prices. And I think commodity prices, most people don't give it enough credence to how big a negative effect that has on the economy.
Haven't we learned our lesson? I mean, haven't we seen already past Feds try and create inflation in the housing sector, for example, to relieve the pressures of, say, the burst of the internet bubble, and then we got into kind of a big mess?
Been there before, right?
I think you saw that with Greenspan. I called the processes Mr. Greenspan undertook infinitesimal incrementalism. I mean, I think it was very, very negative trying to tell the economy and the markets exactly what you were going to do every meeting, and those very slow interest rate hikes. The market was able to anticipate them. In fact, most of my friends made an awful lot of money anticipating exactly what was going to happen in the market. More importantly, as you know, I think that one of the real negatives of that was the explosion, in this case, of oil prices. Right. And oil prices are very, very negative as they go up. The U.S. uses about 20 million barrels of oil a day. A $10 increase is equivalent to almost $75 billion a year of consumptive drag. And
that's what you expect, by the way, through this. If we get the QE tomorrow, that the market is kind of expecting about $100 billion a month. You expect a $10 increase in the barrel of oil.
It's already happened already, so I think it will happen again. And I think some of this will also be path dependent. So I think what you're going to get tomorrow is two things. I think, one, the Fed is very scared about disappointing the market. So I think you pretty much know that they're going to guarantee this $100 billion.
$100 billion or 500?
Well, I think over a 6-month period. I think they're going to do $100 billion a month plus or minus. I also think it's going to be left open-ended so that the markets have the comfort that they'll keep going as long as it needs to, which I think therefore has the potential to keep the dollar under pressure and commodities to go up higher.
You know, you talk about the process being worrisome, Neil. You said first a very, very fast about face for the Fed, which is unusual for a glacial institution, and then also the public disagreement. I mean, you find this all a little uncomfortable.
It's disconcerting. If you look, Mr. Bernanke appeared before Congress at the, what we call it, still referred to as Humphrey Hawkins, and he said, we're not going to reinstitute QE unless there's a material deterioration in the economy. It took 3 weeks basically before they announced that they were going to keep their balance sheet stable, which required about a $30 billion increase in the amount of securities being bought. And then 3 or 4 weeks after that, this whole massive QE discussion started.
What does that all say, though, then, to you?
Well, two things. First of all, again, central banks think in long term, and their policies take a long term usually. So for the Fed to have made that fast and about face, my feeling was, what are they seeing that none of us see? They obviously have better information than almost anybody. So that was the first point. The second point, which I think is very, very worrisome, is here you have the Fed undertaking really, really unusual steps. I mean, they're monumental. And yet what you have is a public disagreement among the various members of the board and the regional presidents about what they're doing. And I think to take this type of step, there should be a heck of a lot more public agreement about what they were doing. Maybe, they're very concerned about telling the markets and the economy what they're going to do. They should have coordinated the processes that way.
We got 10 seconds. How do you think the markets are going to play off the news tomorrow, or is it just also priced in?
I think it'll be might be a little sell the rumor, buy the facts a little bit, but I think they're putting a floor for the short term on asset prices. And I do think one thing you have to worry about, I think employment's already stagnating, and I think over the next 6 months the economy is going to struggle. So they run the risk that the economy doesn't respond and people get nervous going forward.
Neil, great to get you in. Thank you so much.
Thank you very much.
We got to get you back here.
Absolutely.
We'll talk some more. Neil Grossman, TKNG Capital.